It's me, Stephen Thomas, with yet another housing debrief. Thank you so much for joining us. Really appreciate it. Right now in the market, what we're seeing is a little bit of subdued activity, and it has a lot to do with the fact that we're rolling into the spring market with close to 7.5% interest rates. And normally during this time of year, what we get is this big, not a big, but we see the inventory rising, and demand typically rises at a similar pace and then finds a peak between April and May. But what happens is when we get above that 7% threshold, it's a big psychological barrier for a lot of buyers out there, and fewer buyers can actually qualify for a home. What they in turn do is they walk out. There are fewer buyers in the marketplace. It's still really busy if you're within the entry level ranges, but at the end of the day, we're just seeing a little bit less demand, and we're seeing inventory go up. So that's kind of what we're seeing in the marketplace. We're still getting a little bit of a rise in demand in many, many markets. It's just not at the pace it would be if we had interest rates below that 7% threshold that I just talked about. So we're going to talk about higher rates for longer, because a lot has unfolded as we have gone through this week. And we had CPI last week, and we had retail sales this week. And there's just been a lot of really positive news for the economy, which means that we're not going to have the rates come down as quickly as once anticipated. So higher rates for longer. We're going to talk, we talked about this last week. It came out. This is CPI. This is what everybody is looking at. And I want everybody to zoom in on those purple dots where it says last 12 months. And actually the CPI, what we've had is, you could see from January, February, March, the last three purple dots, that January, it was coming down, but real slow. February down a little bit more. And then March came along and it went up a little bit. This freaked everybody out. And but remember, this is just one inflation read. And I said that there was going to be another inflation read this week. It's actually next week, a week from Friday. It will be towards the end of the month. We will get personal consumption expenditures called PCE. It's actually the Fed's favorite. It's their go-to inflation indicator. And for all intents and purposes, it too is supposed to be flat. It's not actually supposed to go up, but it's supposed to be flat. So that is kind of what the expectations are within the marketplace. And so far, the way a lot of these most recent readings have been is everything has been exceeding expectations. So this is the personal consumption expenditure that I talked about. This is for the month of February. We're waiting for the one that comes, and this is at the very beginning of April. We actually got this PCE. We're going to get the next one, like I said, a week from Friday, the end of April. And that will tell a lot. This is actually a better index for where inflation's at. It's when they say that they want to be towards 2% target, what they are referring to is this 2% target of PCE. And it's right now at 2.8% for core. And they want it to come down to 2. They want it to come down to 2%. Now, where they anticipate it's going to be by the end of this year is at 2.6. It's at 2.8 right now. So slowly but surely, it's going to come down a little bit incrementally until it gets down to 2.6. But really what this is proving with CPI and PCE coming down so slow at this point, it came down quite a bit from its heights. And this is where inflation was rampant, out of control. Now, the last mile is what everybody's referring to in economics land. And that is, the last mile is the most difficult to get from where they are today down to that 2% target that they're looking for. And so that's going to prove to be really hard, because inflation has been really sticky, and it is coming down, but just not at the speed that many had anticipated. So the Fed, based upon everything that they're seeing is, and they articulated this is Jerome Powell's up in Canada, and he actually has taken some time to talk a little bit about what they're planning on doing. And he, in a news conference, talked about that they're not in a rush to come down and make these interest rate cuts that they had originally anticipated. So they're not going to make any kind of a move until they see more significant data points that point to actually doing that. So the message right now is the overall economy for the United States is once again, kind of like 2023 and 2024, so far for the first 3.5 months is exceeding expectations. Actually, for us, we didn't think that we'd see a slowdown until the spring or summer. But with more and more of these, it's got a lot of people convinced it's not going to come until the fall. So right before the national elections is what they're thinking is when the slowdown could actually occur. So if it even happens at all, because there's some economists that actually don't think that there is going to be any kind of a slowdown this year. And really what they're focusing on when they say that, they already told you, they said 3 rate cuts just a few weeks ago. They still said, yep, still 3 rate cuts. Yep, that's exactly what we're going to do. And not a lot has changed other than that CPI read and a few other readings that show that the economy is hot. But overall inflation is, they already said it's going to go from 2.8 to 2.6 by the end of the year, and it's going to make its way down there. That's not a big giant jump from where they're at. So they're kind of know that they're a little bit restrictive in their policy, and they know that they're going to make their way down to 2.6, but they want to see something happen. And what they're referring to is in the jobs arena, because jobs has been extremely strong. And you could actually see this, the U.S. job openings, when we got during Jobs Week for the first full week in April, we saw the number of job openings are still, it's sticky high up at about 9 million. And where we were prior to the pandemic was right around 7 million. So the Fed really wants this thing to come down below 8 into the 7s, and they'd be a lot happier. And then the number of jobs that were created in March, it was a lot hotter than expectations, as well as the unemployment actually came down a little bit. So you could just see the overall gist is that the economy is doing fine, that the overall labor market is doing fine. So they're not in a rush to make a cut. And that's what Jerome Powell actually talked about up in his Canadian news conference. And then U.S. retail sales came out this week, and you could see that what I'm pointing to is actually there's those 2 big stacks. January was down, but then we got to February, and it was up a lot. It was actually revised up. And then we have March here. And March beat expectations as well. So you get the flavor. So you have really good retail sales. You have a really good job market. You have inflation's coming down, not as fast. So do they really need to start cutting? They don't feel the pressure. They don't feel the pressure from anywhere in the economy. Pressure is brewing. They know that there are headwinds, but it's not the big headwinds yet. So when they start to see some serious headwinds, a few more, then at that point, they could make those cuts. And you could see, like with initial unemployment claims, it's been stuck at an extremely low level. It's where we were prior to COVID, though. So really what we're looking for me personally, it's not more unemployment claims. It's actually for like maybe the job openings to come down and a few other weakness areas of the economy, so then they can go ahead and make a couple of cuts this year. So this is what Jerome Powell stated. He actually said it will take longer than expected to achieve the confidence needed to get inflation down to the central bank's 2% target. And by the way, this 2% target that they're talking about, it's not that this was started in the 90s, and the United States didn't even adopt it till like 2012. So this 2% target that they're talking about is an arbitrary mark that it was one European country that said that that's what they want to get it to, and then a number of other countries adopted it, and the United States adopted it as well. The Fed wasn't the first one to make the adoption of this 2% target, and now there's a lot of talk about this 2% target that they're talking about. It may be closer to 2.5 or 2 3/4. So that you'll hear more of that down the road, but this is what they still want to get towards their 2% target, and they want to see more evidence that it's making its way there. And also said, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. So he's saying data dependent. Now, after he said this, basically what's happened is originally they were talking maybe we'd get a cut in May, and then it moved off to June. And now the June cut that everybody was talking about has now been pretty much moved to September. And so it's getting further and further out as to when these rate cuts can actually happen. And it doesn't look like it's going to be 3. It looks like it'll be 2 at the most, maybe 1 in September and maybe 1 at the end of the year in December. So that's kind of how the market has been evolving. So this spring market that we have in housing, you have to look at it as it looks like these interest rates at 7% plus are here to stay until we see something in the data. Now, everything that Jerome Powell is talking about and other economists are saying, okay, this is the way it is. This is the way it's going to be for a long time. But that's not necessarily true. All of a sudden, we can get surprises in the data. We've had a lot of surprises to the upside. Later on, we might get some surprises to the downside. But for now, what it means is we've had all these surprises to the upside. What that means is that 7% plus interest rates are here to stay for the spring market, which is going to take a bite out of demand. Maybe in the entry level, there's still a lot of buyer competition, but rather than 10 people bringing in offers, you get 5 offers that come in because 5 of those buyers are no longer in the marketplace. That's kind of what we're dealing with, where it takes a little bit longer to sell a house, and you have to be really careful on pricing if you're a homeowner looking to sell their homes. But if you're looking for that entry-level house as a buyer, you shouldn't be looking for any kind of a deal because you have to pay more of an interest rate because sellers aren't looking to unload their properties. There's not a lot of where I really have to sell or I'm really in a pickle right now. There's not a lot of those sellers that are that extremely motivated for a big discount. So it's like, where are we at right now? The bottom line is we are very, very data dependent. So we're going to be looking at every single data point. I go to fxstreet.com and actually look at their all their economic charts, and they have everything dialed in for around the world. But what I care about the most is the United States and the ones that will move interest rates. That's moderate to high movement on interest rates. So I'm looking at that on a daily basis. This is fxstreet.com. This is for the month of April. This is what it looks like. And this is what we have to do right now because the Fed has stated that that is what they're going to do. They're going to continue to look at every single data point until we finally see that overall we get some movement where either inflation comes down or we get jobs not quite as robust and hot as it has been for quite some time now. So we're looking for something to break. Either inflation comes down or jobs. That's pretty much the big thing. So because we're waiting for that, in the meantime, every little nuance of the data is picked apart and it's moving interest rates like crazy. We've actually seen interest rates move from in the mid 6s at the start of the year all the way up to 7.5%, and it's now been stuck above 7% for nearly about 10 days now. So that's where we're at in the housing market. That's where we are on rates. Looks like a higher for longer is here until we get a break in the data. It is anybody's guess as to exactly when that's going to happen, and that's a lot of what's going on. Nobody is certain as to exactly where we're at, so we all have to rely on the data, just like the Fed is, because they don't want to make a wrong move. But once the data starts to show it, there will be changes in the marketplace. But that is not right now. This is what the market is. We've got to let our buyers and sellers know that this is exactly what we're dealing with so that we can set expectations for everybody that's out there. So if you're a buyer or a seller, just know that this is the market that I've told you. Higher rates for buyers and sellers, it might not be as hot as it was just a couple of months ago when we had rates in the mid 6s. When interest rates go up a whole percent and now they're at 7.5% or close to that, it's a very restrictive real estate market. So buyers don't want to really overpay for anything. They're very meticulous and careful on pricing, so you have to be priced right as a seller. So please like and subscribe to the channel. If you like the content of what you hear, we'll continue to bring it on a weekly basis. You go to reportsonhousing.com to see one of our many subscriptions. We're in the Bay Area as well as Southern California, all the way from San Diego up to Ventura and the Inland Empire. And then in May, we will be in both Vegas and we'll be in Phoenix. So the most recent one that came out, the most recent report is called Starter Home Squeeze. And what we're seeing in this is we're seeing the luxury ranges that are actually have more homes coming on the market and more closed transactions year over year. And in the starter home, the entry-level arena, we have fewer homes coming on the market and fewer transactions as well. So it's just one of those things where it's hard enough at the starter home level, and it's got even harder because few of these homeowners are placing their homes on the market. They're just enjoying their low rates and staying put. So by the way, you can utilize the coupon code HOME for a free month if you subscribe. But I just really appreciate you coming again and listening to another housing debrief. I hope you have a fantastic finish to your week, and we will see you on